With the potential for a U.S. economic slowdown, we think investors face economic uncertainty. Further, lower interest rates likely will accompany expected rate cuts by the Federal Reserve. In such a scenario, we think one investment worth considering is high-yield bonds. Let's take a closer look. The landscape of high-yield bonds has undergone significant changes, marked by notable improvements in credit quality. BB and B rated issuers currently comprise a substantial portion of this asset class, reflecting an increase from the 20-year average. This shift signifies a more resilient and diversified pool of issuers better positioned to navigate economic challenges. Stringent lending standards and higher interest rates also help to restrain excessive debt accumulation and stabilize default risk. As a result, we expect default rates to remain relatively stable around the long-term average of 3 to 4%. The rise in interest rates over the past 2 years have led to a decline in high-yield bond prices, setting the stage this year for potential price appreciation if rates were to fall in the near future. Anticipated Federal Reserve rate cuts further contribute to the optimism surrounding high-yield bonds, and today's elevated yields enhance returns and are historically aligned with robust future performance. Analysis dating back to 2000 suggests that high-yield bonds with yields of 7 to 8%, which mirror current levels, have delivered promising returns a year later in most cases. These findings underscore the potential for high-yield bonds to represent the sweet spot for investors in the current market environment. We think the expectations of Federal Reserve rate cuts and improved fundamentals will continue to support high-yield bonds. Also, a benign default outlook provides an attractive backdrop for elevated yields. In light of these factors, investors may find adding high-yield bonds to their portfolios beneficial, especially for diversification and risk management considerations during periods of equity market volatility.